The volume profile gave you the map, the levels where price should react. Order flow is how you read what actually happens when price gets there. And this is my absolute favorite trade. At a key level, a 5-minute candle sweeps the lows on heavy bearish delta, POC in the wick. Then it closes bullish anyway. That candle is the trigger. Sellers trapped, a buyer absorbing everything. With the confluences stacked, it's the highest conviction signal I take, A++. Before we go further, here's the single most important idea in all of order flow. There are two ways to trade. A market order is aggressive. It fills instantly by taking whatever is already resting in the book, and that taking is what moves price. A limit order is passive. You post it at a price and it just sits there, waiting for someone to come and trade against it. So market orders take liquidity, while limit orders provide it. Hold on to that, because absorption is simply one side firing market orders into a giant wall of limit orders, and the wall doesn't budge. Every price really has two sides: a bid just below, where buyers are waiting to buy, and an ask just above, where sellers are waiting to sell. When you sell into a waiting buyer, you hit the bid. When you buy from a waiting seller, you lift the ask. Now here's the key. A footprint takes every price level and splits its volume in two: how much was aggressively sold by hitting the bid, and how much was aggressively bought by lifting the ask. That's why each price shows two numbers. Here, 340 hit the bid on the left, sellers, and 890 lifted the ask on the right, buyers. So buyers won that level better than 2-1, and that lopsided win is what we call an imbalance, visible aggression, chasing instead of waiting. When those buy imbalances stack level after level, that's not noise, it's a coordinated move. It works in reverse too. Stacked bid imbalances, 3 or more in a row, are aggressive sellers showing their hand. Hold that idea. Stacked bid imbalances down at a low become a key tell later. You just saw the two sides of every price, the bid and the ask. Delta is simply those two subtracted on a single candle, the aggressive buying that lifted the ask minus the aggressive selling that hit the bid. If buyers pushed harder, delta is green and positive. If sellers pushed harder, it's red and negative. Stack the delta from every candle across the day and you get the CVD, a running score of who's winning. It's not about how much volume traded, it's about who was leaning on the market. And when price goes one way but the CVD quietly goes the other, that's your first warning the move is about to flip. Quick reminder, a market order buys or sells immediately and pushes price, while a limit order just sits and waits at a set price for someone to trade against it. Absorption happens when one side is aggressively attacking a level with market orders, but price doesn't move. Why? Because the other side has large limit orders sitting there silently, eating every single order that comes in. The aggressor thinks they're winning. They're actually getting trapped. The key principle: high volume. No movement. Someone very large is on the other side. Every footprint tells its story by comparing two things: effort, how much volume and aggression went in, and result, how far price actually moved. Big effort and a big move, aggression worked, and the move keeps going. Big effort but no move, that's absorption. Someone passive is soaking it all up. Little effort and little move, exhaustion. Both sides simply stopped pushing. Little effort but a big move, thin liquidity. Price slid through a gap with almost nothing in its way. Only one of these is worth trading. Huge effort, no result. That is the fingerprint of a big player hiding in plain sight. Absorption and exhaustion look identical on the chart. The difference is volume. Ask one question: is the volume heavy? Heavy volume while price refuses to move means a passive player is still absorbing every aggressive order. Volume drying up with delta fading means traders simply stopped pushing. That's exhaustion, usually just a pause before continuation. Same stall, opposite cause, and only absorption is tradable.
Price is sliding down into a key low, and sellers are confident it breaks and keeps falling. So they hammer the bid with market orders. Volume spikes. Delta goes deeply negative, but price barely moves. What they don't know, a large passive buyer has resting limit orders right there, absorbing every single sell order. When sellers stop, there's no more selling pressure, but there's a massive buyer already positioned. Price launches.
Absorption at a random price means nothing. It needs a reason to be there. A prior day or week high or low, and high or low volume node, a higher time frame fair value gap, or the value area high or low, or at a point of control. These are the levels where big buyers actually have a reason to step in. If there's no structural reason for them to be there, ignore the signal entirely. Location is not optional. It is the foundation everything else is built on.
The setup needs a specific candle. First, a small consolidation range forms, 3 to 5 candles coiling at a level. Then one candle sweeps below the range, creating a long, lower wick. That wick needs to close back above the swept level, a bullish close. Negative delta means sellers were the aggressors. Ideally, higher volume than the range candles that preceded it. The sweep loads the trap. The bullish close springs it. This is the key signal inside the footprint. The bid POC, the price level where the most sell volume concentrated, should sit inside the lower wick, not inside the body. Why does this matter? It means sellers were most aggressive at the wick extreme, the very bottom of the sweep. That's exactly where the big passive buyer was waiting. Sellers hammered the bid hardest right where they got absorbed. The bid POC in the wick is your confirmation. The delta flip is your green light, but you need to read it correctly. Watch the absorption candle. Delta is negative, sellers dominated. Now watch the very next candle. A real flip has 2 requirements. First, delta turns positive with meaningful size, at least 20 to 30% of the previous negative value. Second, and this is critical, the candle itself must close bullish. A positive delta with a bearish candle means buyers were still aggressive, but they're still being absorbed. That is not a flip. That is continuation. Only positive delta plus a bullish close equals a confirmed momentum transfer to buyers. Don't market order in at the close of the absorption candle. Instead, place a limit order just above the bid POC of the absorption candle, the exact level where the absorption happened. Wait for price to pull back to that level after the initial move up. If it tags you in and holds, you're entering at precisely where the big buyer absorbed. Your stop goes below the wick low of the absorption candle. If that wick low breaks on a close, the trade is immediately invalid. No exceptions.
Everything you've just learned works upside down. At a key high, a candle sweeps the highs on heavy positive delta, buyers chasing, then closes bearish anyway. Those buyers are trapped. A large seller absorbed every order. Ask POC sits in the upper wick. The delta flips negative on the next candle, and you short the retest below it with your stop above the wick high. Same setup, mirrored at the highs. Here is the complete checklist. Structural location, prior session low, volume node, fair value gap. The sweep candle, long wick, closes bullish, negative delta, higher volume. Bid POC sitting in the wick, not the body. Stacked bid imbalances at the wick low rows, 3 or more consecutive. Delta flip on the next candle with meaningful size. The retest entry above the bid POC, stop below the wick low. Location and the sweep candle are non-negotiable. Everything else adds conviction. The most expensive trap, absorption, then price just keeps falling anyway. Sometimes the big player is absorbing to get out of their own position. They're distributing, not accumulating. The candle looks perfect, delta flips, you enter, and price rolls over and drops. So you need one hard line in the sand, the wick low of the absorption candle, its very lowest point. A wick poking below it is fine. That's just a quick test. But if a candle actually closes below that low, the buyer is gone and the trade has failed. No hoping, no waiting for another bounce. Out. A candle with bid POC in the wick during a clean, strong downtrend is usually just a pause before continuation, not a reversal. Sellers are resting, not getting absorbed. Absorption is strongest when it comes at a structural level and after a directional move where sellers have already exhausted themselves to reach that level. The harder they fought to get there, the more trapped they are. 3 more traps to avoid. First, the weak delta flip. Negative 9,000 to positive 150 is not a real flip. The positive reading must be at least 20 to 30% of the negative value. Anything less is noise. Second, no range before the sweep. The consolidation range is what loads the stops that fuel the reversal. Without a range forming first, there's no trap to spring. Price just free falls, so ignore it. Third, news and macro events. Around CPI, FOMC, or the jobs report, avoid the setup within 5 minutes of the release. That volume is noise, not genuine positioning. Divergence is when price and the CVD disagree, and there are 2 flavors. Exhaustion. Price makes a new low, but CVD doesn't. Sellers still nudge price down, yet the aggression behind it is fading, so the move runs out of steam and reverses. Absorption. CVD makes a new low, but price won't follow. Sellers hammer the bid, but a large passive buyer eats every order and price holds. Both flip the market up, and absorption is exactly our trapped seller setup. Watch the CVD, cumulative volume delta, during the consolidation range before the sweep. If CVD was declining during the range, sellers were slowly draining it. Then the sweep candle shows a dramatic CVD reversal. That inflection point is the sign that control shifted. The CVD slope going into the setup tells you who was winning the range. The CVD flip during the sweep confirms who won the battle. The tape is the live feed of every trade as it prints, and how fast it scrolls tells you how hard people are hitting the market. Watch the tape speed as price sweeps to the wick extreme. It will be fast. Aggressive sellers firing. If the tape suddenly slows right at the extreme before the candle closes, that is seller exhaustion in real time. Second tip, if price retests the absorption level after your entry and holds, same conditions, possibly another absorption candle, that is a high quality add-on entry and confirmation your first read was correct. Here is the full sequence in order. 1. Structural location. Your level must have a reason. 2. Range forms. Coiling, loading up the stops. 3. The sweep below. Long wick, closes bullish, bid POC in the wick, negative delta. 4. The delta flip. Momentum transfers to buyers on the next candle. 5. Retest entry. Limit order above the bid POC, stop below the wick low. Remove any one of them and the edge degrades. Together, they are the absorption setup. Absorption isn't a pattern you memorize. It's the fingerprint of a big buyer quietly eating everything the sellers throw at him. No secret algorithm, no magic 3-letter system whispering in your ear. Just real buyers and sellers at a level that matters. A sweep candle that closes bullish on bearish delta at a key level. That is my A++ setup, and now you know exactly what to look for.
One warning before you trade it. A setup is not a system. Don't take it live until you've run it through a full framework and a risk plan, and paper trade it first until the read is automatic. Subscribe and join the CTTG Discord for live order flow analysis. Link below.